Listen, if you owe more on your car than it's actually worth, then you need to watch this video, especially if you're not just trying to stay in this situation and you actually want solution. So this article came from Consumer Affairs, and it talked about a growing number of car owners are underwater on their auto loans. Basically, they owe more than it's actually worth. So, what are the details of the article? They talk about more than 1 in 4 car trade-ins are underwater, a 4-year high, according to Edmunds. Underwater car owners are carrying thousands in debt into new loans, with some owing over 15,000. So they're trading in their car to get a new vehicle with a new loan, but it's having a balance. So when they trade it in, they wind up paying way more than they typically would have, because they just had to get into this new vehicle, when in all actuality they were upside down in their current vehicle, and this pushed them in a deeper hole, has them paying a lot more in interest, etc. Let's keep going. Buyers rolling negative equity into loans face record high monthly payments averaging $915, which is insignificant because now you're paying for a car that you're not even driving, that you traded in just because you wanted the new vehicle. Now, I do understand that there are unique circumstances that require a person to have to get a new vehicle. So this is not bashing. I'm just saying that if you're paying that much, what they've done is factored in what you owed on the previous car into this current car. So you're paying for 2 cars but driving one. Make that make sense. The Federal Reserve Open Market Committee meets this week and is widely expected to cut a key interest rate by a quarter point. If it does, it could make auto loans slightly more affordable. That would serve as much needed relief for consumers. Let's keep going. I don't want to read it verbatim, but for many borrowers, the gap between what they owe and what their cars are worth isn't small. The average amount of negative equity in the second quarter was 6,754, slightly below the first quarter of 6,800, up from 62 in the second quarter of 2024, and even more concerning, a growing portion of drivers are dragging major debt into their next purchase, like we talked about previously. But 32.6% of underwater trade-ins carried between 5 to 10K in debt, 23.4% owe more than $10,000, and 7.7% were upside down by over $15,000. Now, we have a strategy known as the IS strategy that I give to the people that are in the community. You can access that by clicking the available links near the video, but basically it shows a person how to double down and get rid of their debts faster, including but not limited to car loans, auto loans, putting you in a position to where you have some equity and not being upside down. Now, this is what you got to understand when it comes to a vehicle. A lot of times people end up having more that they owe than the car is actually worth because of how they bought the car initially. What you want to stay away from is going to a dealership in most cases. Now, sometimes it could work out depending on your situation, but when you go to a dealership, in most cases, they're not necessarily going to give you the best deal, and sometimes they may try to sell you what they want the dealership to sell, which incentivizes the dealership. So when you go to the dealership and they're trying to get you to get that newest car, the new that year model, then that benefits the dealership, not you, because they know that they want to get rid of those, because at the end of the year they're going to have to drop the prices on those, lowers their commission, and it doesn't cause them to hit those targets that they were wanting to hit. You want to position yourself to not buy one of the newest cars off the lot, because the minute you pull it off, it loses its value, hence putting you in a situation where you're more likely to be upside down, all due to the fact that you bought a newer car off of the lot. That's one mistake. Another thing that you want to strongly consider doing is, instead of going through a dealership where they can run your credit multiple times, consider going through a bank or a credit union. And credit unions are typically good about making sure that whatever car you get, they know that the price is justifiable, because they don't want to lend you money if they know that you are likely to be upside down, because you being upside down driving a car that you don't want puts them in a position to not get paid. So they're very concerned about that. But other banks are great as well. If you have relationships with other banks that may not be a credit union, you do want to consider going directly through them, because it's one inquiry, and if you have a relationship with them, then that's helpful. Plus, when you go to the dealership, you already know what you're working with, and you can kind of control the narrative or negotiate and say, hey, yeah, I'm looking for something in this price range, because you already got the cashier's check, and it's almost like you're paying with cash, and you know that you are approved because you already have the money. You already have what you need, and now you just have to sign it over to them. And then if you negotiate properly, you can get it to cover any of your initial fees associated with it, so you can get your tags, registration, sales tax, etc. So let's keep going. High stakes. Consumers being underwater on their car loans isn't a new trend, but the stakes are higher than ever in today's financial landscape. Now, I already told you some of the strategies that can help you, but this is something that I just got to really make clear, because it may be you, maybe somebody that you know, it may be, something that you just want to avoid when you do get your next car. You don't want to put yourself in that position. Either way, you just want to take whatever applies to you. And if you are looking for a solution is available. But car buyers fall into negative equity when they purchase expensive vehicles with a minimum down payment. So that's another way, and finance them over extended periods. What they mean by that is they may finance it over 7 years instead of 5 years, 6 years instead of 5 years. So the lower time frame, the better in many cases. Now, I know some of the shorter time frames, like 36 months, can cause your payment to be higher, but it definitely can position you to not have negative equity. And then it goes on to say that the vehicle's value drops faster than the owner pays down the loan when you get these longer payment terms. And then what you got to understand is that, yeah, you love the car today, hopefully, but when your car is not being paid off in 7 years, will you still love it the same, or will you feel like you're paying money that you regret? And that's not a position that you want to be in. It also goes on to say Edmunds' analysis shows that how costly negative equity can be. In the second quarter, buyers rolled debt into new loans and paid an average of $9.15 per month. We talked about that earlier. But just understanding the car value versus the loan balance is key. And if you understand this, then you can position yourself to not be in that situation. If you already are in that situation, what you want to do is implement our IS strategy. It helps you overall with paying down any and all debt, but more importantly, it positions you to have a strategy that can help you get your credit up, but at the same time get more equity in the car that you may be concerned about at this very moment. So I highly recommend, if this video at least opened your mind or at least spoke to you in some way, shape, form, fashion, consider joining the community. When you join that community, you'll get all access to things that can help put more money in your pocket, help you boost your credit, help you increase your cash flow in the form of making money as well, because more cash flow helps you dig yourself out of the hole. Don't shy away or run away from more cash flow. Sometimes people are terrified. I don't want to make any additional money, or, I don't want to, have a side income. Energetically, they really do. They just are terrified. So they just block their blessing or their ability to even open up a new stream of revenue, and they just decline it. People automatically have a default no built in. Don't let that default no keep you from the yeses that can bring in more cash flow and help you hit your goals faster. Hopefully this video served you well. Mr. Smith signing out. I look forward to seeing you inside in the community. Talk to you soon. Salute.